Hello, it's Peter Stimson from MPowered Mortgages in the studio today rather than from my house. It's Thursday, the 10th of April in the afternoon, and who'd have thought it? Donald Trump has changed his mind. Again. And we now have lower tariffs across the world, except China, of course. Why has he done this? Well, lots of speculation going round. The reason we're thinking he's done it is to do with US government treasuries. If you look at the chart going up on the screen now, you'll see the last 5 days of US 10 years, and you'll see the volatility. US 10 years have gone from around 4% up to around 4.5%, and you're getting some massive intraday swings of around sort of 15, 20 basis points. US has got around 36 trillion of debt spread across the world, and they need to refinance around 9 billion this year, of which around 70% is between January and June. So every little swing upwards is costing the US government huge amounts of money. So we think the pressure and the volatility in US treasuries is probably one of the main reasons the US has had to back down. Since they've done that, there's had some stability in the market. So, that's obviously, we think, the main reason they've changed. What does that mean for the UK? Well, probably not very much immediately. We've still got the 25% on steel and aluminium. We've still got the 25% on cars, and obviously we've still got the same 10% on the UK as a whole. What it does mean, obviously, is our trading partners, which is obviously the EU, they're obviously in a much better position, and obviously that means we've less chance of going into recession from that side of things. Graph going up now is where swaps have reacted, and as you can probably see, there's not really much of a change. There's still probably or most likely the possibility of a bank base rate cut going ahead in May. We've still got the sort of widening of the 10-year and the 5-year widening above the 2-year. Talking to some traders in the swaps market, there's still this kind of large volatility going on and still this kind of, big movements we're seeing in swaps on a day-to-day basis. One thing, we're seeing and one thing we're sort of feeling is, despite the facts that, rates have fallen, there is kind of no certainty or no guarantee that rates continue to fall. So, if your client is looking for stability and has that sort of uncertainty about what to do next, there's still this view that, 3-year and 5-year rates in particular are offering sort of decent value at the moment. So again, if there is a client who's looking at that kind of market and thinking, do I wait for rates to continue to fall? Again, we sort of emphasize that, this isn't a one-way bet that rates continues to sort of keep dropping through time. That's it from us at the moment. Like I say, things are sort of, pretty steady. Well, steady is a relative term in this current market. We're still waiting for the next Donald Trump tweet to kind of change things, but it's relatively stable in simple terms. That's it from us. Thanks.